Good afternoon, everyone. I'm Rashi Khatri, and on behalf of Co India Advisors, it's a pleasure to welcome you today for GIA Knowledge Session Series with Nisus Financial Services Limited. Nisus today stands as a fully integrated cross-border urban infrastructure investment platform with operations across India and the GCC. Since its landmark IPO in December 2024, the company has scaled rapidly, expanding its capabilities across fund management, transaction advisory, and now construction execution. We have with us on the session today Mr. Amit Goenka, Chairman and Managing Director, Mrs. Mridula Goenka, Executive Director, Mr. Manish Meena, Director of Strategy and Corporate Affairs, Mr. Sunil Maheshwari, Chief Financial Officer, Mr. Mahesh Mudha, Promoter and Managing Director, and Vishal Mudha, Director of Strategy and Operations for NCCL Limited. Nisus manages 1,906 crores of AUM, excluding NCCL, compounding at over 95% annually since FY22, supported by specialized strategies that span the entire real estate value chain. A key strategic milestone this year has been the acquisition of NCCL, completing a deep value entry point, which brings material operating scale, including a 2,350 crore active order book across more than 30 AAA rated developers. Nisus has also become the first AIF business in India to earn a credit rating with a BBB plus from CareEdge, underscoring its governance strength and institutional grade processes. Internationally, the Dubai platform has emerged as a strong growth engine, now managing over 1,030 crores fund of AUM and executing high quality deployments such as 525 crore Motor City investment with regulatory approvals from both DIFC and IFZA and a combined India GCC pipeline exceeding over 4,600 crores. Nisus is uniquely positioned to connect India's capital surplus with GCC's growing demand for urban infrastructure investments. Today's knowledge session series is designed to give you a deeper understanding of this evolving business model, the company's recent performance, and the strategic direction ahead. It's also an opportunity to engage directly with the management team of Nisus and NCCL and ask any questions that will help you enhance your clarity on the business. We will begin with a few slides for business overview, after which we will open the floor for Q&A. Over to you, sir.
Thank you very much, Rashi. You've done 90% of our work, so thank you very much. You've given a very crisp outlay about Nisus Finance. It's a pleasure for us to welcome all our participants to your company, Nisus Finance Services Co Limited, along with the management of New Consolidated Construction Company Limited. I extend a very warm welcome to all of you this afternoon. As Rashi has rightly pointed out, we're one of the fastest growing urban infrastructure, finance, and transaction advisory companies, focusing on India and emerging markets like the Gulf region. We have created a very new benchmark for ourselves on multiple counts. I'm happy that we're joining today, being the first year anniversary of our listing. We listed on 11th December last year, and we've exactly completed 1 year today. So I congratulate each one of you and thank you for your stoic support and faith and trust in your company. And I hope that we're able to live up to that trust for many, many, many years and decades ahead as we continue to scale and grow at unprecedented rate. As Rashi rightly pointed out, our revenue has been growing at over 112%. Our AUM has been growing at over 100% year on year for the last 4 years. Our PAT margins have been growing at over 191% year on year at CAGR group for the last 4 years. So it is clearly with that objective, with that trajectory, that we continue our journey unabated. So just to explain to you, our friends, many people confuse us with an NBFC. NBFC has an asset liability management and ALM management business. It has to manage NPAs. We do not have that problem. We do not have debt on our books. We do not have the problem of debt servicing. We do not have the problem of write downs. We do not work on NIMs. We are not affected by interest rate margins. But we cater to a very large private credit audience in India and globally. Some people tend to compare us with AMCs and mutual funds. Again, unfair comparison because we're again not in the distribution business. We're not guided only by our AUM. Our margins are a function of solution, intervention, exits, and monetization from very high value projects in India, UAE, and other markets. So it's a specialized situation intervention of capital, of networks, of relationship, and our business acumen. So there's a very large pipeline of those transactions, which is a turnaround story for our investee companies. It is a monetization story for our clients on the advisory side. It is a growth story for our clients and our investee companies. It is not an AUM investment, which is generating a certain rate of return, and we're only booking fees on that, which is exactly why it's a twin engine model, providing a four box structure within Nisus Finance, being transaction advisory and asset management in India as well as the UAE. So these four quadrants are at extraordinary speed given one, the total growth of the sector, both in India and UAE. We're growing at unprecedented rate. What has been constructed in the last 5 years or will be constructed in the next 5 years has not been done in the last 50 years. So there's an extraordinary amount of capital outlay. There's an extraordinary amount of development happening both in India and the GCC region. Now we have become a full stack. So let's look at the key milestones that we've achieved in the last 12 months since we went public. First, of course, we became the first public company. Second, we've accelerated our UAE operations, which have become live, have started growing great amount of AUM, great amount of returns. Our NAV is already up potentially by 40% in the last 12 months. We are growing our advisory business at breakneck speed across both as more and more development companies who are scaling come to us, acquire land, acquire an NPA asset, help them monetize some of the assets in the hands of several asset owners. So there's a huge amount of work happening on property development, data centers, warehousing, group housing, commercial, etc. on the advisory side as well as on the investment side. Today, so the UAE office has become an important operation with us having now a DIFC license. The second milestone has been, of course, the launch of the UAE fund itself. Today, we have the largest banks as partners. We have recently partnered with Emirates National Bank of Dubai. We've partnered with Bloomberg. We've partnered with First Abu Dhabi Bank. We've partnered with Mashreq. We've partnered with some of the largest banks in the country in the UAE to be able to grow our book size and to be able to acquire more and more assets. So again, we are the first in the country to be able to do that in the UAE. The first fund in the UAE to actually set up a global fund which can actually acquire special sets assets. So again, a very huge opportunity worth almost $5 billion for us. Third is we announced tokenization. We are en route to tokenizing assets. People may have heard that today the UAE government has announced a digital dirham. And okay, so CBDC is now live and valid as a digital currency, and tokenization is one of the largest plays for the government of real assets. We're at the forefront of that. Another huge opportunity. Again, one of the first players to actually announce that and start tokenizing assets and opportunities in the region. Next, of course, the most important milestone, as was mentioned earlier, is us joining hands with Mr. Mahesh Mudha and being a significant stakeholder in NCCL, the 70-year-old conglomerate powerhouse of construction, having delivered nearly 300 million square feet, accelerating to a 5,000 crore order book with very large value, with very strong counterparties. And that's a very large multiplier. Like I mentioned, what we are going to build in 5 years, having been built in 50 years. The largest bottleneck was delivery and construction, not demand, not capital, not geographic intervention, but it was regulatory intervention. It's purely capacity. Today, with this capacity getting accelerated, we become a full stack house from the ability to acquire, complete, monetize, exit, and capture the value chain in the entire urban infrastructure space. So in a lot of ways, people say we're looking as if we're modeling around Brookfield or Blackstone, which have got this twin engine of advisory, strategic acquisition, and investments across key markets. And they're listed entities as well. So we're, of course, in a lot of ways similar to that, but in a lot of ways very unique because of our ability to create a very high value proposition for our clients and investors. Multiple funds have performed very well recently. You would have read we exited a recent investment from our book at almost 23% IRR. Our ability to churn cash, return back money to our investors in our fund, generate high yield, be able to redeploy that capital has kept us as one of the best performing fund houses in India and also recognized globally for our performance over the last 12, 13 years. Something we're very proud of and which is accelerating further capital. As was mentioned, there's a huge amount of liquidity in India which is chasing the right opportunities. There's global liquidity chasing opportunities in the UAE as well. We are the only bridge in many ways targeting a blue ocean. People do get confused. What are we? We are a leading infrastructure, urban infrastructure, real estate, investment advisor and investor, asset manager in emerging markets with execution, structuring, investment, and exit capabilities. It's a full play. Of course, it happens as a sum of parts. We have our fund investments, which give us a very high annuity from fee. Carry is still not booked, which is an upside, which happens when we're not recognizing carry today. It's only cash on cash income. There's a very large amount of fees we're generating as a pipeline of deals both in India and UAE. And of course, with N sale coming in, we're able to accelerate the relationships that both of us have. The largest corporates of India, whether it's L&T, whether it's Piramal, whether it's Godrej, whether it is the largest sort of clients that they have, we're able to accelerate in mutual engagement with some of the largest corporates who are also developing very very large projects for themselves. So I think it becomes a very very unique high growth engine, which is positioned squarely in the middle of India's GDP growth story, which is on the back of development, which is on the back of infra push, which is on the back of creating 50 new cities in the country. As we are seeing, GCCs are today no longer, but the global capability centers are no longer limited to Bangalore or Hyderabad. We have global capability centers coming up in a Nagpur, in a Vizag, in many other parts of the country as these are becoming cities and megapolises. Nisus Finance is already there, accelerating with its investments, with its acquisitions, with its ability to help the local players also expand their solutions. So I think that's really the structure which is very important. We are continuing to create new and new landmarks and milestones for ourselves as we become one of the most prominent players. We are one of the oldest players in the space. We have almost 600 years, man years of people strength behind us. As we continue to expand, we're bringing in more and more talent. We're bringing in more and more partners so that we become the most formidable force in the emerging markets within India, within the GCC region, and other emerging markets as a homegrown urban infrastructure, real estate investor, transaction advisor, solution provider. So, in a lot of ways, when you look at listed financial companies, which will have an NBFC, which will have advisory, which have wealth, which have other businesses. If you look at it as a sum of parts today, each part is contributing an extraordinary amount of return, an extraordinary amount of growth, and an extraordinary amount of profit. Because obviously we're able to keep our costs tight and create very high margin returns and therefore high fees for ourselves. So I think that's largely the business model that you will be aware of. The market size is extraordinarily large. India is looking at almost 3.5 lakh crore rupees of investments in urban infrastructure itself across asset classes each year, with major firms like HDFC Limited, like DHFL, like many others, which were focused on the sector, not available anymore. It is on to us, the few fund managers, to be able to step up and provide that capital, and we're getting a very huge wall of capital to support these investments. Likewise, in the UAE, it's accelerating with Vision 2030. You would be aware that the UAE is creating some of the largest infrastructure projects, including some of the largest entertainment, business, and work avenues, including the Disney, including the largest casino, including some of the largest business centers and a DIFC too, and commercial spaces, largest expansion in data centers, warehousing, etc. And of course, fueled by luxury housing and affordable housing at the same time. So again, that's a very high growth region, which is completely in the center of our action. And we're able to get therefore a lot of support from local banks, local investors, global investors who are very happy that we set this up. They're willing to come on our platform, willing to contribute more and more capital. On the other side, the regulators are very close, are very happy with us. They're happy to support us, from Dubai Land Department to RERA to the powers that be, were very, very supportive of our endeavors in the region. We built a very strong ecosystem for ourselves, which is why we're able to play the entire value chain seamlessly within the UAE. And our ability to expand in India with multiple strategies is next to none. So therefore, their ability to expand in India with multiple strategies is next to none. Their extract value and ability to identify opportunities is next to none. And so therefore, they're committing a large amount of capital with us as well. So, friends, colleagues, stakeholders, I think it's unto us to continue to accelerate this opportunity. There are a few other things in the pipeline. As you know, we're looking at high growth centers and growth for urban infrastructure on the back of on the back of land banks, which support uh, industrial parks, warehousing, data centers, building developments, etc. There are fixed income asset classes that again are coming to us in a very large way to be able to offer it to the market. So our ability to expand in India with multiple strategies, our ability to expand in the UAE and GCC with multiple strategies continues to get accelerated every quarter, which is why the growth engine continues to. We've just got started. I always mention that there are peers of ours who were at our mark in terms of AUM, maybe 6 years ago. They were at maybe 2,000 crores. Today, they're at 60,000 crores in 6 years. So the ability to scale, we are at a very deep inflection point where we are going to see a very large upward hockey stick growth because of the tailwinds in our favor in our markets, our ability to have diversified into markets which are high growth, being at the center of that market, getting a very huge amount of support from all key stakeholders across our markets, supported by global capital and global institutions, and our ability to curate the right strategies, at in a timely manner, has become our growth engine. And we've just got started. I think there's a journey which is very, very exciting. We're supported, of course, by NCCL as a group company, who are getting a very strong support from the market as they accelerate their capabilities to take on more and more work across asset classes. They've been one of the foremost in constructing pharmaceutical facilities to education to hospitality to healthcare to commercial to residential. Some of the largest parks in India have been built by our company. They are very excited to now continue to do that. They're excited to further expand their footprint to global markets. They've delivered also in global markets in the past. They're happy to go back and expand their footprint in global markets as well over the short to medium term. So therefore, a very huge trajectory also in their favor, given that again, just like us, there are very few players who are of institutional grade within the construction space. There are very few players of institutional grade within the investment and advisory space as well. So I think a combination of that creates a very, very strong imperative for growth, for profitability, and unabated upside for all of us.
Thank you, Amarji. There was too much of information overload. So let me try to break it into smaller buckets. And
Yes.
so, Amarji, well, we could not have chosen a better day. It's your, listing anniversary. So unfortunately, good things also happen sometimes. So good to see that. Manishi, can you stop sharing the presentation? Thank you. So, Amarji, I just want to take a step back and understand from you, how did you start your journey? Meaning, this is something which is different, not normal people do. So, where did you start? What was your first fund? What was the thought behind it? Can you just take us back from your starting? Where did you start?
It's a very good question, and thank you for that, Abhijit. I think the India really has started to become an develop institutional capability to develop world-class assets only since 2005 with Press Note 3. Press Note 3 of 2005 for the first time allowed global funds to step into India and actually partner with the right developers and start creating institutional grade asset classes on commercial, on residential, on industrial, hospitality, etc. And that's when it was obvious to me that given the size of the country, we never really had a formal construction real estate sector. It was all mom and pop shop. It was all distributed in local markets. There was no national player. There was really no ability to understand what can be built and at what quality and scale. So I think that was the inflection point in my mind, which really started to. So effectively, real estate is only a 20-year-old sector. Now, 20-year-old sector, which obviously started in 2005, had a challenge in 2008 with the global economic crisis, again accelerated from 2010. So effectively, it's only in the last 10, 15 years that the sector has started to achieve global recognition and scale, with REITs having been recognized and invested globally. And that's really when I realized in 2007, 8, when I started focusing entirely on the sector, that this is the time when institutional capital, institutional development will come to the country. You will need capability on the capital management side, you need capability on the development side, you need capability on the construction side, be able to build Bharat. That is what we've seen in the last 10 years as well, is the vision of Bharat, the 2047 vision. And I think that is really a culmination of what started almost about 20 years ago as opening up of the foreign direct investment regime to start with. Then, of course, with smart cities, with the opening up of REIT regulations, AIF regulations, so many things have happened in the last 10 years from a regulatory standpoint, RERA, GST, that it only continued to affirm our confidence and our vision that this is going to be the largest sector. It already is, in terms of employment, in terms of GDP contribution, in terms of number of SMEs involved in that. It is already the largest. It is also the largest consumer of capital from FDI, private credit, AIF. So it was very obvious that given the size after farming and defense, this is the largest space in the country, and you need very strong professional managers, people who can imagine how this country is going to get built, how this country is going to, how Indians are going to consume, global audiences are going to consume assets in the country from infra to open infra. We realize this is a space that can get accelerated. We will need people like us to be able to make it happen.
So did you start with the transaction advisory business, or was it the funds
Well,
itself?
yes. So when we started in 2013, of course, we started applying for a new license. I was heading Knight Frank to move on to starting a company called SL Finance, where again we had raised funds, we've invested, we're incorporating the company in 2012, 13. And of course, while we were applying for a license, we already knew that there was inbound demand for capital. So while we were raising capital, I said, let us at least first start arranging capital while we're getting a license and launching our first fund. So 2015, we launched our first fund. So in that interim period, we were obviously creating a book of investments while we were assisting our clients and investors in inbound demand for capital or for solution as advisors. So for 2 years, we booked a very significant advisory revenue. Hence, we've never burned cash. We kept on generating significant revenues for ourselves. With that, we were able to sponsor the first fund from 2015 to 2020. Very successful outcome for that fund. Again, because we were doing this twin model, and this twin model has been something we've been doing since 2006, 7. So it's not new. We've
Okay.
always believed that the value of advisory and asset management are actually joined. If you're not providing advisory, then you're only a ATM, you're only printing money, or you're only providing money on demand. And that is not value creative for anyone, neither for the lender or the investor or for the investee or the borrower. You have to be able to provide intelligence, and you have to be able to provide solutions.
So, Amitji, I mean, obviously, I can see the synergies between transaction advisory and asset management. So, but there's also a little bit of a conflict out there that people might tell you will sell the lower attractive or less attractive opportunities to them and take the best opportunities for your fund. Does that happen that way, or you also co-invest along with them now since you have a fund, so it gives them more confidence to do the deal?
To understand, it's a very good question again, and it's an obvious thought sometimes. When an opportunity, we see 400 plus trades that come into our office each year. We're investing in barely 20, which
Okay.
means that there are 380 potential asset owners who are looking for a solution. Capital, JV partner, monetization opportunity, expansion, etc., which is not suitable for our fund. Now we're
Hmm.
able to find that solution for them, which our fund is not able to provide capital for. So I think that is
Hmm.
a captive demand first for us. Second, when we look at our investee companies, it's entirely an arm's length, where if an investment makes sense, it goes through the checks and balances of the management, of an independent investment committee, of an LP committee, of the advisory board. And once it passes through all the checks and balances, can the capital get invested? Now,
Mm-hmm.
there is no compulsion for the investing company to use our advisory services. It's all arm's length. They can ask any of the IPCs or bankers or anybody to help them, but they usually partner with us because they know we understand the business backwards. They know the
Mm-hmm.
kind of engagement that we have with regulators, with distributors, with sales agents, with people who are looking for JVJDs for land, where they would like to monetize some of their non-core assets and they would like to, and focus on a certain portfolio of assets. So that's
Mm-hmm.
something we're able to accelerate for them while also, even before we are invested, a lot of them will say, well, I don't know if I can actually take capital today because I have the following problems. Can you solve that problem? When we solve the problem, they become capital worthy. At which
Mm.
point they may choose to take capital from a fund or they may choose not to. So
Okay.
again, it's a very, very arm's length transaction. There is absolutely no subsidization. The fund has been generating extraordinary returns, having curated a very, very sharp basket of opportunities. The advisory business looks at helping those who are not able to get funds from us in many, many
Okay.
occasions.
Okay. Understood. Now, coming to my only brush with the real estate fund has been one of the premier organization, ICSI Real Estate. They did promise 17-18% return, but ended up like 7-8% return after 7 years. So what kind of investments you do for being able to do this kind of spectacular returns that you have generated? How do you choose your investments and what is the thought process? What kind of investment these are?
One is that these are not outlier outcomes. We've been generating this, or I've been involved in almost about seven different funds. We only have three funds here live. But in each fund, wherever, in me and my teams have been involved, we've always had that outcome because we're not doing speculative investments. People lose their returns and they lose their capital when they're doing speculative investments. They go into a new geography, they're trying to buy large tracts of land, they're then trying to figure out how to get approvals, you want to build on it, when to launch it, who's going to buy it, at what price. So there are very, very large number of variables they're trying to solve for which there is no evidence or data. Now, so which means you're left to a speculative outcome. Now, obviously, one is modeling a certain return on certain assumptions that they will be able to get those outcomes if all of those variables are proved correct. All of those underwriting parameters come through. We do not know that. We're going for late stage, last mile projects. Land is bought, approvals taken, construction started. You need to solve a problem. You need to exit a bank, take a little top up, complete a last mile project. You need to load FSI because banks can't lend for FSI, and you need to load the balance 4 floors or TDR and complete those last few floors and exit, or take over an existing project which is in the vicinity, complete that and also exit, which is a part of your exiting scenario. So we're looking at cash to back short term opportunities only. We're not going for long only, which is contrarian to what most people have done. Is that they looked at 7 year funds, let me buy land, let me see what happens at the end of the seventh year. We
Yeah,
don't do
exactly.
that. Our exits are planned before we invest. We know that if you're investing on 1st January 2006, as of 31st March 2026, as of 31st March 2027, I will be fully exited from the following five scenarios. It is not a function of demand, it is not a function of anything.
So
It is
good to know
already
that
premeditated.
it's not land that you are financing, which normally attracts,
Right,
high
right.
interest rate. So this is like special situation kind of funding, where
Absolutely.
where
That's our
you need
specialization.
little bit of capital to tide
That's
over.
right.
Okay,
That's right.
so can you just elaborate on the recent, exit that you did? What was this investment and what exactly, how
So
did it play out?
fantastic. So again, this is a case in point of exactly the solution capital that we provide. Here's a project which was to load a TDR in Bangalore. The TDR policy was available when they started. They'd taken a facility from a bank. Then the TDR policy with the change in regime was withdrawn. They got stuck. They could not complete the building. The TDR policy was reintroduced with the new government. They came to us saying, we need to now repay the bank because the project could not move forward. Can you take over the bank, pay the money, load the balance FSI, complete the project, and help us exit? It was as simple as that. Brilliant location, great configuration, good building, stuck because of a regulatory idiosyncrasy because of change in government regimes in Karnataka. Once
Mm-hmm.
that was solved for, the policy was back in force. TDR was available to get loaded. We said, fine, let's go ahead. We loaded the TDR, got them the balance approvals. We started completing it. There was enough demand for it. Cash flow started accelerating. We were exited. So that's the kind of solution that we're able to provide to all, major of our investee companies, which of course banks can't do. They can't buy FSI or TDR. They cannot pay
Hmm.
for approvals. They can't pay for many of these things.
Okay, understood. So that's a very good, strategy. But these are like niche solutions. So is the TAM similarly big? Because, obviously the TAM is big when you look at real estate. But when you look at this special situation, well, these are very, you really need to be into the game to be able to identify these kind of things.
And we've been at it for 20 years myself. As a team, we have 600 man years of experience in this space. We know exactly which developer, what micro market, what opportunity, what solution. So obviously, which is why we see 400 plus deals a year. And
Mm-hmm.
we're obviously not doing all 400, we're doing 20, 25 deals a year. So there is obviously a large pipeline. Having said that, again, if you see, we're not raising 10,000 crores for one strategy. Okay, then there's too much liquidity being chasing a very small or a relatively small opportunity set. Let's say the demand for special sits is about a lakh of crores. And if
Mm-hmm.
I am putting out 10,000 crores, I'm looking at 10% of that market. Putting out only 4,000, I'm looking at 4% of that market. So when I'm
Mm-hmm.
looking at only 4% of the market, then I have enough opportunities for me to be able to do that. I have 25 times more deals than they can absorb, which is a great situation. So I can be very, very selective, which is why I'm not saying that I'm going to do 10,000 crores, which is why we have different products. So there's
Mm-hmm.
4,000 crores in the special sets. There's another 4,000 crores, which is to be able to do bridge capital funding, where somebody has bought the land, somebody is buying the land, somebody is selling the land, we're providing bridge capital between the two for a span of 6 to 12 months. Okay.
Okay.
So there are these sort of arbitrage opportunities, which is again a very large opportunity for us. Likewise, there are other opportunities in India. So, so we're building 4,000 crores of funds at a time. We're not doing any fund which is 10,000, 50,000, 20,000 crores, because obviously then it means doing what everybody else is doing, buying land and waiting for 7 years. That's
Mm-hmm.
what we can't. Then you can buy, a lakh crores of land. We're not doing that. We're very clear. Exits have to be 2 years. Exits have to be premeditated. Opportunity sizes maybe 5,000 crores for one strategy. That's maximum desired move, which is why funds keep on shutting and starting. Every
Yeah.
fund runs
So,
for 4 years and we
so
continue to
my
move.
next question was, did we ever had to extend the life of the fund because we are stuck?
Never, never.
So how
We've
many
never done
funds
that.
we have closed till now?
2015 started, 2020 closed, 2019, 20 closed, 2020, the second fund started, 2025 closed, third fund now started, 23, closing by 28, 29. So everything has been within 5 years.
Okay, so we have no assets which got stuck ever. Uh,
I mean, during COVID or during some of these regulatory changes, there's been times where there's been some delay, because obviously you're trying to solve for something.
mhm.
But we've never had a situation where we really had to worry about our capital or our returns. Within the
Okay,
time frame that we envisage, money has always come back.
okay. So understood on this. Now, when we look at most of these AMC companies, they spend a huge amount on raising capital. So, what is our strategy over here? How are we able to raise, capital? We are guiding for very strong growth from 1,500 odd to 8,000 crore AUM. So, what is the visibility and what is the strategy?
It's a brilliant question, and I've seen that problem with many fund managers, that they actually have a very negative cash flow or a very significant loss for a few years in their inception years, because there's really huge amount of money in marketing and client acquisition. We've been at it for the last 20 years. Our investors have followed us from fund to fund. They've re-upped their commitments from everyone. Somebody started at 5 crores, today is 50 crores. Somebody started 20 crores, at 200 crores. They brought in their friends and family. So I think one is, there's been this organic growth, because again, to my point, I'm not raising 10,000 crores. I'm
Hmm.
raising 3, 4,000 crores. So which means within our LP pool, within our family offices, within our institutions, there's already ready capital available for every fund, because we're not raising 5 funds at the same time within the same base, right? So our existing LPs keep on rolling their capital from fund to fund and keep on re-upping their commitments and bringing their friends and family. So I think that's kept our cost very low. Second, you see that serially we partnered in every fund. Okay, the second fund was a Dalmia Nisus fund. The third is a BCD Nisus fund. So with every partnership, when we give a small GP stake in a particular fund scheme to a partner, they bring in a lot of capital. They bring their friends and family. So by giving a small economics in fee and carry, I'm able to bring a large amount of that relationship capital to a fund. That again saves a lot of my marketing and distribution cost.
Hmm.
Right. Same thing we've
Okay.
done in the UAE. Same thing
So,
we've done in other markets. So that's been multiple strategies to Keep the cost
Understood.
of fundraise very low.
So, so what percentage of our last fund is capital which came from the same guys who were in our earlier fund also? So, would you say it's like 70%, 80%,
75%.
75,
75%.
75%? Okay, so that's a very high number. So there's a good
Yes,
recall. And because the size of the fund would also be bigger, so maybe
that's
you
right.
needed some new people also to come
That's
in.
right. That's right. That's
Okay.
right.
And is there any concentration in this? Because when you say LPs, one tend to think that there are few guys who are putting in disproportionate. So what would be the proportion of,
I think nobody's over 10% any which ways.
okay,
Most of these are very sophisticated family office institutions who typically have a cap of 5 or 10% of the total fund size. Uh,
okay.
so it's fairly diversified, and most of them are actually much, much smaller.
Mm-hmm. So let's quickly do the, mathematics behind the Indian fund. So, you have take rate of around 3.5%. So how is the structure? Is it like 220, 120,
It is
150?
220. It is 220. But again, so as a percentage of AUM, 2% comes from advisory, 2% comes roughly in India and UAE from asset management, and therefore we're able to roughly earn 4% of our AUM.
Mm-hmm.
And I always say there's a very strong correlation between advisory and AUM. It's very simple. For example, if I am doing 1,000 crore transactions, I will be shown large ticket size transactions. Now, I may not want to do all of them, right? So, the more money I put, the more deal flow I get. The more deal flow I get, the more opportunities I see where I'm not putting in money, but I can solve for that problem. So, as much capital as I have, as many investee companies I'm able to lock in, that kind of advisory income continues to be pro rata to that,
Mm-hmm.
both in India and UAE.
Okay. So, yeah, that's so basically when I look at your, EBITDA margin, they are extraordinarily high, like 75%. Yeah, I mean, obviously, Manish is not complaining, but are you paying enough to your people and how are you motivating them? Is there any SOP options or how does it work?
So as you know, we've announced and we've got approval also from SEBI to roll out ESOP options. That has been a very big driver for our people because they're all investors in the fund. There is an employee quota for money invested in the fund, so part of their income goes there. Plus, obviously there are ESOPs which are being granted, and again there's a share of profits. Again, we keep it very tight. I think that's important. We
Mm-hmm.
still have one of the largest manned uh, managers and advisors in the country with a 60-member team with a target AUM of only 4,000 crores this year. I think we are extraordinarily staffed to be able to manage a much larger. So we already have enough resources. It's important that each resource is pulling their weight. They're able to actually generate very high income from every transaction that we do, for every advisory mandate that we get. And obviously, because we're specialists, we're able to do that. And it's not unique. I mean, there's another peer, not a peer, but another industry leading player who have only a six-member team, and they
Mm-hmm.
did 60 crore rupees of advisory revenue. Their cost was only 6 crore rupees in salary, right?
Okay.
A six-member team, senior folks, very well-known guys, and they did 60 crores. So 50 crore rupees was effectively their EBITDA only on the advisory fee. So the advisory income creates a very, very large upside
Mm-hmm.
because obviously the costs are low, but the fee is very high. And so
Okay. So,
therefore, people do get paid. So even if you were to give another 10% benefit to them, everybody's earned from 1 crore to 2 crore in that year from that, but you still have a 75-80% EBITDA.
and so what is the EBITDA margin in AUM business?
We see it's the same. I mean, if, for
Okay.
example, the AUM business, if you're earning 2% on 4,000 crores, you're earning roughly 80 crore rupees, right? 80 crore rupees, the corresponding cost would be potentially including share of profits would be roughly maybe what 20 crores, 20 crore rupees.
Okay. So
So
similar
yeah,
kind
about
of,
75%. Yeah,
okay. So similar kind of margin. And
similar kind of.
one of the question is obviously as you are growing big, your percentage growth is coming down. I mean, people are used to 100% growth. Now you're guiding for 40%. So that's the problem of being big in size now.
No, I just gave an example where one of our industry colleagues has grown from 2,000 crores to 60,000 crores. 6, 7 years, right? So the space is very large. And by the way, this was only India play. We're also in the UAE, we're also looking at other emerging markets. So having said that, while of course the opportunity, the potential is as large as that to be maybe 10x or 20x, I don't want to say that. I want to say what I can do in the worst case scenario. What I can do in the worst case scenario by being conservative, by being sharp, by ensuring that we have the outcomes that we've generated without diluting on our capabilities, without diluting on our outcomes or exits, without diluting on investor returns. We'd like to ensure that our growth is large enough without diluting on anything. So it's not growth for the sake of growth. It has to be very, very solid, fundamental, and very meaningful for every stakeholder of ours.
One more question on the risks in the AIF, meaning there's one question that, higher returns comes from tier 2, tier 3 developers. So what is the proportion of tier 1, tier 2 developers in our portfolio?
I think it's 50-50. So tier 1 would be 50%, tier 2 would be 50%. The tier 2, which are 50%, the reason I'm calling them tier 2 is because they are not national players, but they're micro market specialists or they're asset class specialists. So somebody is very good at doing redevelopment in Bandra. Okay, but that's his strength and that's what they've delivered. But there may not be somebody who's doing a 2,000 crore GDV every year or a large GDV every year, but they know they're doing only a 200, 300 crore project. They need only 40, 50 crores, but they're serially doing that for the last 20 years. So that's why they're tier 2, but they're very good in their micro markets. They've delivered, they've shown track record. So yeah, as a function of that, therefore, depending on so on that basis of categorization, it's 50-50.
Okay. So any name you want to put out, who are the tier 1 guys? If you want to take one or two names.
In the public domain, it'll be fair for me to name anyone. I mean, they're all partners with us. We've done a lot of work with them as we exit, as we've invested. You'll see that if you were to scan our news, a lot of names would have come out in that news itself. So I think whatever we've disclosed by way of exits or investments, I think is the best bet. I don't know. It would be unfair for me to name anyone right now.
Okay, understood. So, Omkar and Ashish have some questions still, which so he wants a clarification that whether the fee is charged on the AUM deployed or the AUM raised.
There's no fee on commitment.
Okay, so once they put in the money, so you call the money only when the deal is there?
Yes.
Okay, understood.
We don't it's a zero cash balance business. We draw down when there's a deal, we pay out when we receive money.
And so AUM business should be largely, predictable, right?
Of course, it is fully predictable.
Yeah. So Ashish has a question. He's saying that, our trajectory, our advisory income was kind of flattish in the first half, and AUM is also not picking up at a pace that he would have liked. So,
say that again.
So he's saying that in the first half, our advisory income was...
in progress.
Yeah, sorry. So, Ashish is asking that our AUM is not growing at the pace at which, the deal pipeline looks like to be. And secondly, he's saying that, advisory income is also, unpredictable and was flattish in the first half. So
I think that's entirely true. One is that in 2025, look at where we were in terms of AUM, we're at about 1,000 crores. We predicted we'll be at 4,000 crores this year. So we're already at close to 2,000. So if somebody says the AUM is not going fast enough, and 4x is not good enough, I don't know what is, honestly. I don't know what is the expectation in terms of AUM growth. Should it be 1,000 to 10,000 in 1 year? I don't know. Second is in terms of split between advisory income and AUM. See, AUM is an annuity business, but as I said, we charge only when we deploy, right? So, for example, if I have deployed money in August, September, the fees of that will not kick in pro rata from April to September, right? So I've reached that AUM, but that fees will, because it's only on drawn down basis, that fee will reflect in the next, 6 months in that year. Likewise, when an advisory business happens, I already know I'm going to do X amount of advisory business. Now, what happens is when do you invoice? That depends upon the contract. Some invoices happen when you have closed everything and the deal is entirely dusted. Sometimes you get on milestone basis.
Understood. Okay.
So depending upon the contract, and
Hmm.
depending upon the contract, one is able to, depending on the contract, one is able to, book fees. But we know overall what is the total pipeline, what mandates are getting delivered, and what revenue is going to get booked. So that we know.
Okay. So your
As far as
guidance for
AUM growth,
4,000
somebody
crore
said
still
that
remains, right?
1,500 has gone to 1,900. I mean, listen, we're exiting also. So the
Mm-hmm.
incremental AUM is existing AUM minus exits plus additions.
Mm-hmm. No,
So
so when you
is
give the guidance of 4,000 crore, this is a net guidance, right?
exactly that is net AUM on which I'm booking fees.
Okay. So that you are still confident you will have an
Even
exit
if
run
I'm
rate of.
booking,
Hmm.
even if I've added 800 crores of investments, but I've exited 400 crores, I will see net only 400 plus.
Mm-hmm.
So we have to be very clear about what is it that we're saying. We're saying net AUM will always be so much on which I'll consistently book fees.
Okay. So 4,000 crore we should be, you know, ending with at the end of the year. That's what people are
Yes.
trying to ask. So that's our guidance. Okay. Mm, I think so. Largely, I've covered most of the questions on the India business. Uh, let's go to Dubai. Why did you go to Dubai? And obviously, there's a lot to learn from Dubai in terms of real estate. That's the future. So, what exactly is our USP in Dubai?
Well, first of all, we're able to transpose our learning. We're able to transpose our learning from India to the UAE, where we are a mature market. They don't have an NBFC structure. They don't have asset reconstruction companies. They don't have special sits funds. There are no local institutional players who can go and buy assets. Largely, everybody's going, buying a plot of land and developing and selling off plan. So the ability to take our models and our solutions to a market which has got a very large India diaspora.
Mm-hmm.
I think in a light vein, people say Dubai is the cleanest city of India. So, so I think given the kind of migration of Indians, the impact that India diaspora has on the city, the ability to actually transpose that, and given the amount of capital, there are a lot of articles you put out how much capital is actually gone out of India and which is the number one destination. You're
Mm-hmm.
seeing billions of dollars of investments happening between India and the UAE. The Prime Minister is spending a lot of time between the India GCC corridor, between UAE, Saudi, Qatar, Oman. So there's a huge amount of traction that is getting built in terms of opportunities. The GCC is leaning to India for its technology, for its people, for its services, for its capabilities, for its banking, for UPI, for all of these things, right? So when we're providing all of that, it's obvious for us that there's a large opportunity. It's obvious to us. Let's go and capitalize on that. So I think it's an extension of the work we know and we've done.
Okay. So, are the builders kind of common between India and there?
No, no, no. There may be a
Okay.
few common names, but anyway, we're not funding development. We're buying assets. It's a very different business.
Acha, so there, I did saw that you are buying assets which are, you say, 30% cheaper on rental as compared to
Yes,
market. So how does that thing
yes.
work in UAE? Why are they selling at such cheap, meaning they want to offload
Well,
the
that's
inventory?
a very large discussion, to be honest, Kish, that there are idiosyncrasies, like I mentioned in short, there are no asset reconstruction companies, there is no
Mm-hmm.
insolvency bankruptcy code, there is
Okay.
no secondary market for stuck or NP assets, and therefore, if you can create a special sits, and there are
Hmm.
no global funds which are operating in India. You have the likes of Vardy, you have the likes of Oaktree, you have the likes of Polo, who were for special sits fund operating in India. Those funds they have not gone to the GCC yet. Now they're going. So
Okay.
because there was no capital for special sits, we were the first to go in. We obviously got that opportunity.
Okay.
Special sits exists everywhere, exists
Hmm.
everywhere in every market. There was no focus, no product, no capability, no regulation, no institution doing that yet. We were the first to go in and start doing that.
You mentioned about that you are partnered with banks over there. So, what is the role banks play in that's
So multiple things, bank help us identify the assets. They give their non-performing assets from their books.
hmm.
They lend against these assets in a very large way. They are the assurance partner. So banks provide a very large role. In fact, it's on the bedrock of the banking institution that the fund has been built.
Mm-hmm. Okay. So, obviously, you talked about tokenization of assets, and these are all futuristic thing. I mean, do you think these are learnings for India? It will come to India also someday. Are you in talks
I
with
don't
some
know. It
regulators?
should. because right from Mr. Nandan Nilankanni to everybody has been talking very, very heavily on tokenization and digitization of assets. Every quarter, there's a large seminar with one of the greatest minds of India who actually talk about, global leaders who talk about the need for tokenization of assets and creating a parallel digital parallel digital environment. For India, was a while away.
Okay. So I know you have to catch a flight, so I won't really push you too hard, but let's come to NCCC.
Okay, so
Now,
I will join. I will be available, but I'm leaving the conference room now. I have my colleagues and of course Mr. Mahesh and others around. I will
maybe
take
one
queries.
question before you go. This just want to ask this question that NCCL promoter Abbasji's son Salim was also in real estate. Why sold the company
That
to you?
that Mr. Mahesh is best suited to answer.
Okay, so let's Maheshji, can you please unmute yourself and let's have the NCCL conversation.
जी, you are on mute.
जब मैम के पास गया होगा एक्सिस लिक्विड पर 1,80,000 रुपए के लिए।
Sorry,
Mahesh, you are on mute.
yeah, Maheshji, you are on mute. Can you please unmute yourself?
बिल्कुल। हाँ
Rakesh, if you can repeat the question, I will answer by the time he joins.
Yeah, okay. Go ahead, Manishji.
Yeah, can you just repeat the question, Yomi?
No, so there's a question that Abbasji, who used to own NCCL, his son is also in real estate business. So why he sold to Nisus and not give it to his son? So that's the question. If you have any clue on that, happy to hear your answer.
For you?
Yeah, Maheshji is also back, chalo. So
Volume. Yeah.
Maheshji, want to start with a very difficult question for you.
Yes,
So-
yes, please.
So Jaswant is asking that NCCL promoter Abbasji's son is also real estate industry. So how come he has sold it to Nisus and not give it to him? So do you have any insights?
To be very frank, because the reality is that, yes, he has a son, but I've been associated with this family for almost 4 decades.
Okay.
So this organization is built by me very passionately. And Salim, of course, his son is there and he's like my younger brother and a family member. He was always interested to not real estate, other businesses. So this business was an independent entity within the group, and that is where, because in fact, because there was no valuation is a throwaway, because we can say that no valuation game is done, because we are not looking at the big deep pockets. We were at a juncture where, because how to take it to next level, and there we chose Nisus and Amit Goenka for more than, because big deep pockets, deep values, and then their kind of focus and ambition, because what he has in terms of this industry. So I think we have chosen a very good partner without much getting into those valuation games. Started this relationship. That is what is the basic answer is to this.
Understood. So Maheshji, can you please take us through the journey of NCCL and how the advent of Nisus really solved some of the issues which the company was facing, and what should we expect from NCCL in the next 2 to 3 years?
Yeah, look, we've been just celebrating our 80th year in this country. So there are hardly any companies have survived in this industry so long. Second, this is thorough professionally managed company. As I said, for 4 decades is a long period for anybody to be with the company and carry forward. So we have done very good inside in-house the systems, processes. In the industry also, because whenever we are working, we are very choosy while selecting our partners. We always say, more than a contractor, we are a partner. So in past, if you say, because our legacy, what it speaks, that we have been working with clients for 10, 20, 30, 40, 50 years, which generally doesn't happen into this industry.
Okay.
It is rare only. So that is what is our basic strength, where Now, Bagmani Group in Bangalore, in last 21 years, we have delivered more than 40 million square feet of the IT parks for them, including Google, this Ananta building, which is
Okay.
recently, because they occupied. Like with Prestige Group, last 3 decades plus we have been working. Mumbai, we have been working with many of the AAA clients, corporates. So my point is that what we were looking at, the Mr. Senior Jajanwala is 91 plus. Age is age, and beyond a point, because one cannot really pull on. His energy level is still very good. He's he'll be with us as our chairman emeritus, because his what is foundation, because he has created, and what we have been carrying forward is the great legacy, because what we have in our hand. That is where we're looking out for the good partner who understands this business, and that is how we chose Nisus and Amit Goenka and team as a partner. And we have got very robust planning. We got our order book today is around 2,500, which is the balance order book what I am talking, which we are talking about doubling in for the next year or two, which will definitely give us because growing in any business is very easy, and particularly in our business, I've seen many companies, they have come, they have, and how they have, because gone out of the business and so. So the sustaining is very, very important, and that is what is we have learned very good and hard way, we can say. And so those mistakes, whatever we've done in the past, we will never repeat in the future. And now we've got good partner with us. We have been planning, because how organically we can grow, and with the support of Nisus 100%, because we'll have that advantage, plus in terms of getting the exposure to new clients, existing clients also, because they have their own relationship. So it is, because definitely, I think if you ask me, it is a win-win situation for all of us.
Okay. So, Mahesh, when should we expect all this to, reflect in terms of revenue growth or EBITDA margin improvement? Should it start to happen in Q3 or second half or next year?
Yeah, I think starting from the first quarter of FY 26, because
27.
Yeah, 26, 27 will be the real year to see that kind of growth, because we have been all setting things right in this in-house with all the sites, new order booking, because we are very going aggressively, but at the same time very choosy. So all that will definitely will take this first and one other quarter, and definitely we'll all see the by force, because we'll be doing that kind of turnout.
Okay, so from 4,000 crore order book, will it take 2 years to complete that order book, or 3 years, or so? What kind of revenue should we expect?
Average time span is 2.5 to 3 years, we can say.
2.5 to 3 years. So if we have 4,000 crore order book by end of this year, we should be doing at least 1,000 crore plus revenue.
100%.
And what kind of margin should we look at?
See, at EBITDA level, industry margins are in the range of 8, 9, 10, 11% maximum. But because as of today, we are there close to 9 to 10%. And with the now we have implemented the complete SAP new version, where a lot of cost control system is also being put. We have employed a couple of people in terms of the, Vishal, you can mention? PMO and all.
Yeah. So as a company, well, this year has, why we're saying the guidance for growth is in FY 27 is because this year we focus primarily on strengthening our controls, both from a technical operations standpoint and from a financial standpoint. Financial standpoint, we, like Dad said, we've implemented SAP, ERP, working capital, governance, all these basic structures in place, which the Nisus team has been helping us quite strongly with as well. And the second, Dad references a PMO we're setting up. So from a technical, coordinating your planning of execution, your procurement, and even the supply relationships, all those pieces start to come into more of a formal structure and control. And that gives us the ability to extract that further EBITDA advantage in the coming financial year. So we're saying today around 9%. We are hoping to push that to closer to 10
Yeah.
Okay.
and higher tens.
But Rakesh, because one thing you must, I'm sure you are aware that there is a huge, there is no dearth of work in this country today.
That is true.
But there's a huge dearth of good professional contractors. There's a huge dearth. So any
Okay.
100 crore plus, because tender we are talking today, there is because 1, 2, 3, 4, 5 because people are available. Because
Okay.
I'm talking good professional, good size.
Mhm.
And we have an advantage, we have pan-India presence.
Okay.
Another advantage because we are working to all segments, be it receive, hospitality, hotels, hospitals, industrial, pharmaceutical, probably we are number one in the country.
Okay. Mhm.
The reason we chose this partner that because we were waiting for the right partner to take it to next level. So
Mm.
there was a bit of a gap, which now because already it's been filled in, and we are in the process of setting the house into order and
Mhm.
taking the next leap. So
Uh,
I don't see any challenge because only we need to really decide because where to stop, and because that we are very clear. So growth is by force it is going to happen.
Mhm. Okay. And what would be our current debt situation? And do we have enough capital to support this kind of growth?
Yeah, but today this fresh infusion coming in because we are absolutely because cash plus I can say because debt is just working capital what we are using, and if this business is managed well because we don't need to really go for the debt because now with fresh cash infusion, they're not one bank. There are five of them are been discussing, changing, but then it's we are not in hurry to take that kind of exposure of the debt because what we need more of the bank guarantees.
Acha, right. Correct.
Rest
Correct.
of the client they give you the mobilization advance because
Understood.
and manage well because that is where because as my son Vishal was talking because we have put a lot of because control systems within the system because check and check balances. So that is where because Mr. Manish Meena and their team also because very because frequently involved monitoring because you always need that third eye. Because we always feel that we're doing very good, but then because when it is seen and screened by third eye, because you understand, oh, these are the because lacunas or this is where we can tighten the nut bolts.
Hmm.
So we are very clear about because our clarity, thought process, and the growth path also.
Okay. So what is the exact debt amount? Do you recall? Or can we take it later on?
Sorry.
Total
What
debt
is
of 107,
No,
180 with Yes Bank, 180 crores is the
108 crore of bank loan and
that is the working capital.
Working
I'm
capital.
saying.
okay, so there are no term loans, etc. for
No, few term loans, very small amount
another
around.
20 crores worth of debt.
Negligible amount of term loans, Rakesh ji.
Okay.
Negligible
Yeah.
amount of term loan. It is
Yeah.
95-98% is working capital loan only, which is
Got it.
serviceable on their own strength. And
That is again need based, about whenever we are buying any capital assets.
Mm-hmm.
Yeah.
Okay. So actually we have run a little bit over time. Mohit, will do another session with you on NCCL only because there's so much to know about NCCL. But I've got 2-3 more questions before I wrap up. Manish ji, some of the audience have concerns on the pledge. So I'm hoping this is some money you took for NCCL. It's a bank loan pledge or what is it?
For asking this question and you have the opportunity to clarify this. We are operating, we are in a SME space where, if you know, compared to Nisus, NCCL is much larger company. So when we acquired this company, we also needed some external financing, and for that we approached lenders, Tata Capital and DSP was gracious enough to provide this acquisition financing.
Mm-hmm.
We had already repaid. By the way, that's the track record, or that's the confidence what Nisus Engine is all about. We have already repaid over 55% of the total capital raised in record time, and the share pledge was for 3x cover. We have already repaid more than 50% of the debt, reduced our share pledge significantly.
Okay.
Now, in last 2-3 weeks, you have seen some announcements towards share pledge increase. That is largely to do with the reduction in market prices. So when that's covered, we have increased the share pledge, nothing else.
So we are very
Ach-
comfortable on our financial position. In fact, you will see.
Okay, so when will the pledge fully go away? It will take few years.
It is as per the terms with the loan. It's a short-term 3-year loan,
Okay,
and
so 3 years it will go away
that
probably.
it could be much before that itself.
Oh, okay. So the second question I wanted to
So
ask you.
gradually it will reduce whenever we repay. We have a repayment schedule. Based on the repayment schedule, the pledge will also decrease.
Understood. The second question I wanted to ask is there any dividend policy that we have? Meaning now people are saying you have got ESOPs. What do investors get?
Sir, that's a good question. This is something which at internal board we are completing. What would be the right time? Because we are, as you know, we are a very fast growing company, and that growth capital is also required. So it's balancing that growth capital, how aggressively we are going, and also exploring the sentiments of the investor will come up with something. It's still internal right now.
Hmm. Okay, Ashish has been asking this question that when you talk about deep deal pipeline, is it ready to deploy equity capital backed or debt capital that you have with banks? So what is this deal pipeline he's asking? It's obviously
For
the
Nisus, the For
Hmm.
Nisus, the deal pipeline becomes when we enter into a discussion phase, where we enter into non-binding term sheet stage. It's non-binding, but it provides a great comfort that we go into exclusive zone where we fresh out and we start our very deep down due diligence process. So
Understood.
these are the deals where already a non-binding term sheets have been offered. So it provides that much control. Having said that, it is again subject to the DD finding and the comfort and the security cover. As Amit has mentioned in his response, we ensure that the money is provided for certain solution and there
Hmm.
is a clear exit path from it. Those are the findings we go into the details during the DD phase, and accordingly, when everything is right, we deploy the capital.
Okay, so basically this is the investment from the fund,
Yes.
and this is the equity, nothing to do with bank funding or anything like that.
No,
Okay.
no, no. This is the fund investment pipeline.
And there are two more questions which I want to take. Dilip is asking about tokenization. Will there be any income from tokenization? And from which quarter will it be visible?
So tokenization is a concept where we partnered in UAE market. Okay. This provides us the opportunity to do both in terms of creating a marketplace where we earn our advisory income also. It's a place where you are putting, for example, we are acquiring building. We can put that building on the platform, and a lot of retail investors can participate through tokenization instead of buying the full building. You can buy, let's say, as low as 1 square inch of the
Mm-hmm.
property, which is converted into a token. So one fricas, one token is as low as that unit. So lot more retail participation can be increased at that way. This is something where a good asset which is already there, this becomes an exit opportunity. Same time when we are creating these market opportunities, we can also advise in our network that how to leverage these platforms, which acts as an advisory income as well. It
Mm-hmm.
is still in early days. It is going to take some time because for UAE also it is early days of deployment. While regulations and everything, all the hurdles are there. Uh, what create this marketplace, create market opportunity. We are at that phase right now. Create more awareness about this opportunity.
Okay, got it. There are two forward-looking questions, whether you want to do it or not, up to you. One is, has the AUM increased over 1,900 crore after the H1 results? Do you want to mention any number?
We will, because this is still only 59, 60 odd participants. This is something which will make public to all the
Perfect.
all the
And
investors.
okay.
So,
And the other question I want to cover is, uh, we said that there will be some receivables which will be recovered. in NCCL in the Q2 call. So again, I'm hoping you will give an update in the Q3 call about it. Yeah.
Definitely, all the financial forward-looking numbers are something where as a regulated entity, we will disclose it to first to exchange, and then it will become a public information.
Okay. Manishi, anything you are aware of why the stock has underperformed so much? Any reason you can think of? Because investors like the story and they think it's fabulous. What are they missing?
And Rakesh ji, you are on the investor side during this call, and this is something where I would request you to provide some more lights. Job is to perform and deliver on our commitments. That's what we are doing. Overall, if we compare it with the peers and in the SME market, there is definitely a stress right now. What we are observing, it's a broader market trend, not related to one particular stock or two particular stocks. Right now, there is a general bearishness which we are observing from the market. Anything particularly to the investors, in fact, the way we see it, it's a good opportunity to where you will see the segregation very fast. The good players will rebound very fast, and that's how market will reward us as well.
Perfect. Thank you. Thank you, Manishi. Thank you to the whole Nisus team. Please convey my thanks to Amit ji and Mahesh ji. Thank you so much. So we'll stop the recording here. And I'm sure if there are any further questions, guys, please reach out to our team. Rashi is there. You can, drop an email and she'll be happy to get any answers for you. So thank you so much. And
Thank you, Rakesh ji, for a very deep dive. Appreciate
thank
your
you.
time and the intervention. I think we've been able to show the trajectory, the growth path, the strength of the platform, our ability to move very rapidly on a very high growth path. And I think we'll continue to engage very, very periodically to keep on pushing out our milestones, to our investors.
Thank you so much. Thank you, Amit ji.
Thank
Thank
you.
you.